Hello and welcome to yet another edition of Big Deal. I'm Nisha Poddar. Now, Finance Minister Nirmala Sitharaman's record-setting 7th consecutive budget focused on continuity and growth. However, there were some big-ticket announcements on taxation. First, the short-term capital gains tax was hiked on certain financial assets to 20%, while the long-term capital gains tax was hiked to 12.5% on financial and non-financial assets. Next, the buybacks will now be taxed as dividend income. And finally, in a big relief for India's startup ecosystem, angel tax was abolished, a move that will certainly help funding into the sector to go up. To discuss this and more, whatever is impacting from the budget on the deal street, let's get our team of experts to break it down and also understand the technicalities. Let me welcome on Big Deal Ajay Rotti of Tax Compaas, Yogesh Singh of Trilegal, Sumeet Abrol from Grant Thornton, and Amrish Shah from Deloitte India. Gentlemen, so good to have you on CNBC-TV18. Now, my first question to you, Sumeet, how is budget for M&A and deal makers overall?
Thanks for that, Nisha. And to be very honest and to set the context here, I don't really expect annual budgets to have a very meaningful direct or near-term impact on transaction activity,
Sure.
Unless, of course, we are referring to extraordinary events like we did in 1991 on events that transform and change the course for the economy and maybe the country as a whole. But I do see the budget to set more of a directional theme for the deal market, which is basically around ensuring that the economic buoyancy remains intact and the broader framework for around the ease of doing business is progressive. And then, of course, there will always be themes and sectors which will emerge as favorites, which will get wind beneath their wings and through incentives and packages and a whole lot of announcements there. But when I look at this year's budget, Nisha, there are a couple of themes, big themes that really stand out for me, which are relevant for the deal market. I think it keeps the country firmly on the overall path of Viksit Bharat, which is all themed around the 7% economic growth that we've all been so used to hearing now. And that also, I think, within an overall framework of financial prudence and fiscal discipline. And B, it seeks to stimulate domestic demand through a plethora of employment schemes and disposable incomes, increasing disposable income, which should also keep the market sentiment strong. So both of these, I think, augur very well for the deals market. And of course, then there is abolition of angel tax, which is expected to seriously bolster the activity in the early stage ecosystem, which incidentally, again, contributes maximum volumes to the real market.
That's right. In fact, angel tax is on top of my mind. In fact, the amount of euphoria that I have seen because of one budget move in the entire startup ecosystem is because of the abolition of angel tax. This has been an ask for a very long time. Ajay, how do you read into this and how will this work and impact now fundraising?
Hi, Nisha. Thank you. I think, from a deal and startup space, this possibly is the biggest headline that angel tax has gone away. I think, first of all, it shouldn't have been in the statute in the first place, but we had it for a long time and it's finally gone. This government in particular tried to repair it a few times by, taking feedback, having carve-outs, changing valuation methodology, etc. But I think now they've clearly decided that this is beyond repair and has to go. More importantly, I think it's clearly an indication of the government listening to what has been the ask of the entire startup sector. And I don't think there's a single founder who would not have made this request to actually have the angel tax abolished. I think it's one of the good moves, better late than never. And it should, like you said at the beginning, should actually be a positive for more funding into the startup. And this always used to be a problem on valuation, especially the new age startups where, the valuation was not really something that you could justify with any method that you could apply.
That's right. And it comes at a time when the startup ecosystem with lower fundraising, less liquidity, really needed some support from the government as well. Now, Yogesh, from the legal point of view, how do you see this impacting the deal documents, the legal documents, and the overall ecosystem?
Look, I think in the startup space and even BEVC funding deals, we have a very mature market in India now. And this, but what was happening was there was also these kind of taxes when they were being applicable, they were making a lot of deal terms very difficult to impose. And it was bereft of logic when it came to a deal market where funding has been generally difficult, right? And also it has meant the market required a lot of realism. There were a lot of valuation corrections, down rounds, bridge rounds that were taking place. And when it came to legal documentation, there was a lot of struggle in terms of how to implement anti-dilution rights, how to implement some kind of a cover for an investor. Um, and uh, and companies were effectively getting taxed in case they were underperforming from the time they were raising capital. I think those kind of things now behind means that the deal term, that many of the standard deal asks that investors have become much more easy to implement. Particularly, I'm happy that things like anti-dilution and valuation protections will become relatively easier. So it's certainly a positive move. I would definitely add that it would have helped if there was some kind of a indication on what would happen for all the investigations that have been ongoing for this intervening period when the angel tax had been levied. But I couldn't ask for more at the moment.
All right. So that point noted, Yogesh. The first clarification required definitely is also on the investigations that are ongoing. All of them will vaporize, or what happens to that? So that's a good question. Amrish, anything additional on angel tax? If not, then on the big offer for sale being included and that impacting the capital gains for the founders, promoters and investors for IPO-led companies.
Nisha, I think before we go there, just one addition to what Sumeet mentioned. I think if you look at this budget, I think overall from an M&A perspective, it's more an action-oriented budget based on an introspection. The overseas investor was winning, and therefore they have, brought in the abolition of angel tax. They've also said that, we will go in for a overhaul of the tax regime to make it simple and, predictable. So, creating a much more trust-based environment. And obviously followed with all the policy announcements around infra, energy, addressing the job content. So, all of that will augur well, if I have to look at the M&A overall. I think the angel tax key issue, I think, will be basically, now people will not, not dare to ask for the right price. Earlier, if you were asking for the right price for your company, you were being taxed. Now, I think that will be gone. So the confidence will increase from the, startup ecosystem. That's, I think, the biggest gain I see on this one. Coming to OFS, I think, it's a little technical and I might take a little time, Nisha, here. There was a law which allowed, unlisted shareholders to take a benefit of a listed scenario, whereby if they were to offer their shares in an IPO, they could get the lower tax regime of, at that time, 10% and now 12.5%. Provided, they had participated in the OFS, and even if their shares were unlisted as of January 31, 2018, because if you recollect, January 31, 2018 was the cutoff from when capital gains, for listed securities again became taxable, and they grandfathered the market value till that date. So for this, scenario for unlisted shares, they had covered one specific situation as to how the fair market value will be, determined, and they'd assumed that that will apply for all types of unlisted shares. And the situation that they covered was that if the shares were unlisted as of 31st Jan 2018, and then you were to do a OFS, and then you were to do an IPO, and then you were to sell the shares, if at the time of sale you were a listed security, then they had provided for an index cost of basis for claiming a deduction. The same thing in an IPO OFS does not apply, because what happens is that the sale happens when you are an unlisted security. So you are not a listed security on the date of sale. Pursuant to that sale, within 2 or 3 days, the listing is achieved as per the SEBI mechanism. There are a lot of views that were prevailing that because of this, lacuna in the law, it could be held that there's no way that I can compute the cost of those shares while calculating my capital gains, and therefore relying on, an old Supreme Court judgment, it was held to be not to be subject to tax. That was one view. The second view is that since,
Amrish, right now with the impact, is the calculation of capital gains going to increase first? And second, will the entire ecosystem be covered because of this? And therefore change the return economics of the promoters, investors, founders who sold shares, and is it retrospective? Three answers, and then I will move on to another aspect.
Sure. So just to answer them in the backward retrospective, yes, it's applicable from, the date the listed securities became taxable. So it is retrospective. The second is, yes, it will impact promoters, from an overall perspective, because the methodology now provided is that if I had bought the shares, let's say in 2012 as a promoter, I had incorporated the company in 2012 as a promoter, and I had put in 100 rupees. What I now get is an indexation benefit from 2012 to 2018. And that becomes my cost basis for deduction against, my IPO price. Now, I can't replace it with a fair market value as of 31st Jan, or I can't say that I can't compute the cost. And therefore, all promoters will be subject, to my mind, to a higher level of tax, because when promoters invest in a company, generally it is at par value or, little above par value.
Yeah, very low, yes.
Very low. So I think they will be subject to a higher rate of tax. That I think will be the key element here.
Right. All the IPOs can be assessed from the time of April 1, 2018 and the upcoming IPOs. And there are many IPOs also in the pipeline, and some of the big ones coming in from the startup space with a lot of investors as well. So, okay.
Well, whammy there for the past, because now you will be also asked to pay the interest for the shortfall in the tax.
All right. So a lot of dynamics of the profit that was to be made out of the IPOs and the sale of investor as well as promoter founder shares at the time of offer for sale. Retrospectively, the capital gains tax can go up. That's one of the very big impacts that we are seeing from the budget coming in. And of course, tax experts are working on the nitty-gritties and technicalities. All right, on that note, we'll slip into a short breather, but there are many other changes and the technical aspects that we are going to put threadbare right here on Big Deal after a very short break.